The field of finance can be complex, but learning about standard financial terms can help you understand economic concepts and apply them to your life. Having a clear understanding of such terms may also aid your financial decision making. When you take the time to study these concepts, it can also help you discuss financial topics with your coworkers, clients, and investors more effectively. Welcome back to another video of Framework Finance, and today we are here with some top 10 basic financial terms. 1. PE. The price to earning ratio. PE ratio is the ratio for valuing a company that measures its current share price relative to its earning per share (EPS). The price to earning ratio is sometimes known as the price multiple or the earnings multiple. In an apples-to-apples comparison, investors and analysts use PE ratios to determine the relative value of a company's shares. It can also be used to compare a company against its own historical record or to compare aggregate markets against one another or over time. 2. PB. The PB ratio reflects the value that market participants attach to a company's equity relative to the book value of its equity. A stock's market value is a forward-looking metric that reflects a company's future cash flows. The book value of equity is an accounting measure based on the historical cost principle. It reflects past insurance of equity, augmented by any profits or losses, and reduces by dividends and share buybacks. The price-to-book ratio compares a company's market value to its book value. The market value of a company is its price share multiplied by the number of outstanding shares. The book value is the net assets of a company. 3. EPS. Finally, earnings per share (EPS), one of the most common items highlighted in an earnings announcement, provides investors with insight into a company's earning health and often affects its stock price after an announcement. EPS is calculated by taking net income, subtracting the preferred dividends. For the sake of simplicity, let's assume Hemlock doesn't pay dividends on preferred shares, and dividing the difference by the average number of outstanding shares. 4. PEG. The PEG ratio compares a company's PE ratio to its expected rate of growth, a key factor for assessing its value. A company that's expected to grow its revenue, earnings, and cash flow at a high rate is, all other things being equal, more valuable than a company with little growth opportunity. Growth companies tend to have higher PE ratios than value companies for this reason. Investors are willing to pay more for potential growth. High near-term prices aren't necessarily a problem when they see the growth potential. However, how much an investor should be willing to pay for growth remains. A growth at any cost approach can result in paying too much. Even for a great company, the PEG ratio can help an investor put a price on a company's growth rate. 5. Market cap. Market capitalization refers to the total dollar market value of a company's outstanding shares of stock, commonly referred to as market cap. It's calculated by multiplying the total number of a company's outstanding shares by the current market price of one share. For example, a company with 10 million shares selling for $100 each would have a market cap of $1 billion. The investment community uses this figure to determine a company's size instead of sales or total asset figures. In an acquisition, the market cap is used to determine whether a takeover candidate represents a good value or not to the acquirer. If you made it this far, make sure to stick around to the end of the video and hit that like and subscribe button as we move to our next phase of the video. 6. Dividend. A dividend refers to a reward, cash or otherwise, that a company gives to its shareholders. Dividends can be issued in various forms, such as cash payments, stocks, or other conditions. Its board of directors decide a company's dividend, and it requires the shareholders' approval. However, a company doesn't need to pay a dividend. The dividend is usually a part of the profit that the company shares with its shareholders. 7. Profit margin. Profit margin is the percentage of your total revenue that you keep as profit. But to calculate profit margin, you subtract overhead expenses as well as direct costs from your sales and then divide that by your total revenue. Profit is ultimately what makes businesses valuable, but many large and small businesses take time to start generating a profit. This shouldn't be taken as a day-to-day indicator of your company's financial health, especially for young companies. 8. Revenue. Revenue is the money generated for normal business operations, calculated as the average sales price times the number of units sold. The top-line figure is from which costs are subtracted to determine net income. Revenue is also known as sales on the income statement. It is necessary to check the cash flow statement to assess how efficiently a company collects money owed. On the other hand, cash accounting will only count sales as revenue when payments is received. Cash paid to a company is known as a receipt. It is possible to have receipts without income. For example, if the customer paid in advance for a service not yet rendered or undelivered goods, this activity leads to a receipt but not revenue. 9. Yield. Yield refers to the earning generated and realized on an investment over a particular period of time. It's expressed as a percentage based on the invested amount, current market value, or face value of the security. Yield includes the interest earned or dividends received from holding a particular security. Depending on the security valuation, fixed versus fluctuating, yields may be classified as known or anticipated. Since a higher yield value indicates that an investor can recover more elevated amounts of cash flows in their investments, a higher value is often perceived as an indicator of lower risk and higher income. However, care should be taken to understand the calculations involved. 10. MOAT. Conceptualized and named by Warren Buffett, an economic moat is a distinct advantage a company has over its competitors, which allows it to protect its market share and profitability. It is often an advantage that is difficult to mimic or duplicate brand identity, patents, thus creating an effective barrier against competition from other firms. Every successful company understands the main threat to their continued success will be from competitors, and keeping them at bay is critical to sustaining their dominance. With time, they are likely to see an erosion to the bottom line as competitors eat away at their market share, which is why a business that intends to remain dominant has to establish an economic moat. Economic moat describes a company's competitive advantage derived as a result of various business tactics that allow it to earn above average profits for a sustainable period. Well, that's all we have for you today. If you enjoyed the content of this video, click the subscribe button so you can receive more content like this every week. Make sure to comment and let us know. Also, if you have any other recommendations or have any feedback, let me know. I would be happy to check it out. Till then, stay tuned.